Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
Hello and welcome to the Portfolio Matters review of 2020. As you will have noticed, we're unable to meet in person, so like the rest of the world, we are stuck in our bedrooms, communicating via Zoom for the, which is suboptimal, but we do what we can. So, as I hope you will have seen from the Portfolio Matters introductory episode, the podcast will be very much rooted in our real world experience of financial markets. So the way we would like to start this review of 2020 is by talking through our experience of the year as seen through the prism of our portfolios. Now, Richard has had an absolutely extraordinary year, and he will now talk us through exactly how he returned 70%, and I, for one, will be taking notes. Richard, over to you.
Thank you very much, Keith. I would say I was very lucky. So I went into the start of this year quite heavily invested in the shares of gold mining companies. And let me just bring up my performance chart.
So the first thing I noticed looking at your portfolio performance, Richard, is just, well, how extraordinarily positive it was, which means that you must have taken a sizable bet on these small gold miners. Just what proportion of your portfolio was committed to them?
Yeah, so my portfolio is around about 50 to 60% gold and silver mining shares. Some larger companies and some smaller, more speculative shares. And the what you don't see from the graph is that in the middle of March I had a spike downwards, which actually by the end of March had rectified itself. So at one point my performance was considerably worse than that graph shows, because that is just an end of month graph. So there was a concentrated bet, which I think if you have a thesis which you're fairly convinced is correct, that my philosophy is make a fairly concentrated bet on that thesis, but be prepared to not have your timing right, and you may have to hold for a substantial amount of time. And there's this thing called path dependency, isn't there, where you may invest at point 0, and 3 years later you may be up 3 times. But if between point 0 and 1 year later you're down 50%, you probably have exited your position.
Yes.
And that's path dependency. So although at the end of the time it looks like everything's hunky-dory and you've done fantastically, either you were holding through a very painful drawdown period, or you exited and probably never went back in because you lost confidence in the position.
Yes. Well, what I really like about what you did, Richard, was when the trade went against you, you got out, but then changed your mind and got back in again. And I think the difference between what you and I do and what a professional investment manager does is that they view risk as being the way to minimize risk is to have a wide variety of assets which all have different performance, and their differing performances offset the risk of each individual position. Whereas you and I both fall into the category of speculators, where we have quite concentrated positions, but we watch it every day and we try and be fast on our feet. And that means you really do need to, when it goes against you, you need to get out.
So one of the things,
prepared to take losses.
Yes. So one of the things with the gold mining shares was I was always convinced that the price of gold was going to go up, but the market was reacting differently.
Yeah.
And rather than sitting there taking increasingly painful losses, I did exit some positions. But then when it was obvious that gold had hit a bottom, I bought them back. Now that's sort of luck, really, in the sense of I was watching it. Nobody knows when the market hits the bottom, and I was lucky to get back in when I did. I was lucky to be holding them when we went into the beginning of the year.
Yeah.
And I think I always try and think of these things as one is, you put a lot of effort into trying to be right, but if you are right, you're also, there's an element of luck in it, and you can't avoid that element of luck. So I also had, I'm also fairly convinced that blockchain technology is going to displace a lot of existing business practices over the years, and it's a little bit like the internet was in the early 1990s. And obviously we had the 2000 internet bubble, and there's no way of telling whether we're going to have a 2022 or whatever it is blockchain bubble. But I think that so my investment in it was in a company that invests in blockchain technology, but also in Ethereum and Bitcoin. And so the last part of the year I benefited from having those investments. And I think that one of the issues with Bitcoin is that I don't actually believe it's a store of value, but I do believe that it's a facilitator of disintermediation technology. And I think disintermediation technology is a powerful trend that we're in. And I think it's important that everybody tries to make an investment in that at the right time, in the right way, but understands that it's not a digital gold for me. It's an investment in a technology.
Right. Well, I know, well done, Richard. Down with the kids, embracing new technology. But I personally am very skeptical about Bitcoin, and I think we will have a longer discussion about this in the predictions for 2021 section coming up. But the other thing I wanted to ask you about is the UK market has relatively few small cap and mid cap gold miners, which I would consider to be investable. Now, I know that you have actually invested in a lot of Canadian stocks,
yes,
which begs the question, how did you find them?
That's a very good question, Keith. So I suppose I just have trawled around. I just trawled around, really. I was interested in small cap gold shares. So I'm not particularly interested in buying shares in politically unstable regions, mining shares in politically unstable regions, which leaves basically Australia, Canada, North America, and South America to an extent. So that cuts down the universe of investable shares substantially. I'm not actually interested in investing in what's known as, I think, moose pasture shares, which is basically someone's got a bit of land and they hope there's gold underneath it. So I'm looking, and I've probably invested half a dozen smaller gold mining and silver mining companies. So I'm looking for something where there is either significant resources at a presently economically viable concentration. In other words, if assuming they can get the stuff out of the ground, when it's refined, they can make a profit at the current price of the metal. They may not necessarily make a profit now, but they can make a profit without the price. So you're not sort of speculating if gold goes up to $5,000 then. And so it's just really a question of trawling through these companies, reading what you can.
So you're looking at the actual company accounts. You're finding out a list of listed companies in various, say in Canada, in the gold sector, and then you're actually going through to the company website, looking at a presentation or the annual report. Is that right?
Yes, well, I'm looking at the geologist's report that they release to investors, which say what the grams per ton and so forth is, and the size of the Now, I'm not an expert, but you can get a rough feel for if a gold mining company's got a resource that's 10 grams a ton, it's this, and if it's got 50 grams a ton, it's that. So you start to get a feel for it.
Yeah. I'm reminded of Mark Twain's quip about a mine being a hole in the ground with a lyre on top.
Yes.
And the trouble with all these presentations is that they always look fantastic.
I absolutely agree. I couldn't agree more, Keith. It's not. That's why a lot of quite a substantial amount of my money is in larger companies.
Right.
But the smaller, more speculative companies give a big kicker.
Yeah.
Potentially.
Yes. And I would also say that this has been a year where there has been a speculative frenzy, actually. So even some of the poor quality mines, in fact, the worst ones, I think, if you look at the London market, they're the ones that have done best.
Yeah.
The ones that were really, trading at a fraction of a penny have suddenly gone to 3p, which is a tenfold return or whatever.
Yes. Assuming you can get in with a bid offer spread of anything sensible.
And so in the latter half of the year, you traded out of some of the gold and into some clean energy stocks. Yes. Can you just talk about what the idea was behind that?
Well, I think coronavirus has appeared to have sort of awoken in a much greater sort of realization of the damage that we're doing to the world with carbon emissions. And I think it has probably acted as a catalyst in some way to sort of people's general viewpoint of that, which I guess is understandable because suddenly everyone has become very concerned about health in a general sense. And there were a number of announcements. Boris Johnson announced, was it full decarbonisation by 2050 and removal of internal combustion engine from new vehicle sales new car sales by 2030 and so forth. And when you go down that route, there's a vast amount of infrastructure that has to be built. You're also using modern magnet technology in motors and wind generators and so forth, which were highly reliant on rare earths. So you've basically got battery elements, lithium and vanadium, you've got rare earths for magnets, and you've got, in my view, you've got uranium for nuclear fission. So these investments were investments in companies that mine or develop in those areas. And they have done remarkably well. I think there's an argument to be said there may be a bubble. We don't quite know how supply and demand is going to resolve itself over the years. We don't know whether there's going to be substitution as some minerals become too expensive. There will probably be technological substitution as new technologies are developed using different materials, better technologies. So it's very uncertain, but there's definitely a big groundswell of interest in developing and investing in renewable energy.
I completely agree, and we both have similar investments in this space, having discussed them quite extensively in the final quarter.
Yeah.
And the performance has been really extraordinary. The speed with which these, say, lithium miners or rare earth miners has moved, and the new battery technology companies has been extraordinary. And I, for one, think that the market has got ahead of itself. Having said that, the one reason why we both really like this trade is that it's a trade where the buyer is actually price insensitive. So it's being mandated by the government. And the price of neodymium or praseodymium, which are required in 200 kilograms are required by a wind turbine, is actually a relatively small part of the overall cost of the project. So, you know, cost of rare earths could go through the roof, and yet they will still be required. So I am concerned by the price rises and the valuations that a lot of these clean energy companies are now on. We both have invested in some new battery companies which have negative earnings, very small sales, and enormous share prices, share market capitalizations. And I will be looking to offload some of those in the coming months.
How will you work out what proportion of your holding to offload, Keith?
Well, as you know, Richard, I'm quite binary on these things. I either like it, and the thing is, I think in order to hold any company, you have to have confidence in it. Because my psychology is that if the share price starts drifting off and I've lost confidence in it, I'm going to sell it. So therefore, there's this path dependency to my holding.
Yeah.
So if I assume that I'm not going to get the timing absolutely right, and at some stage the price is going to drift lower than where I am now, I'm going to sell it at a worse price. Hence, when I get out, I just tend to sell the whole lot. And if it drops down to a price I like, I might get in again.
So it's quite interesting, this discussion, because my view of gold mining shares is that countries are going to continue to devalue their or print quantitative ease fiat currencies, and they have no choice but to continue to do so in one way or another. And for me, that means that the value of gold, and I believe silver, will continue to go up.
Yes.
Now, and we know roughly what the annual mine production is of gold. It's around about 3,000 tons. And we know that can't really change very much. And we know that there isn't really a substitute for gold unless you happen to believe that Bitcoin is. But the issue with the lithium and rare earth elements and battery technology and so forth is that we know we're going in the direction of clean energy. We don't actually know what the direction ultimately, or what the path we take will ultimately be. Yes. Nor do we know how fast it will be, nor do we know who else is going to come into the market and either cut prices or introduce a new technology which will obviate an investment in what will then become an old technology. So there's a great deal more uncertainty about it.
I completely agree with you. And also, the market is extrapolating very strongly current trends and investing in those trends. So if you look at, let's say, the market for lithium, S&P Platts, who are commodity specialists, estimate that in the next 5 years, the amount of lithium will be coming onto the market will be treble what the price is now, the volume is now. And if you look at the price of lithium has actually massively declined over the last 10 years. And the market will now have to absorb 3 times as much lithium in 5 years' time than there is now. And you have to assume a vast increase in battery usage to absorb all that. And also, you have to assume that the battery chemistry won't change, and it won't become more efficient in using lithium. All of which seem very aggressive assumptions to me. So I very strongly think that the number of lithium miners with quite high valuations on the UK market, and I actually this morning wrote down a list of all the mining companies listed just in London. Right. In Toronto, there are vast numbers, but in London, there are, I reckon, 7 lithium miners, in all of which have growth prospects or currently have no production but a mine they're hoping to develop. I just think that's unsustainable.
I think that's right, and it reminds me of the mining clock, which
yes, we will go through.
Which we will go through, but basically, the higher the price, the more income, more people join the party until the price drops.
Precisely.
And there is.
But having said that, I would add the proviso that right now, I don't think the market really cares what's sustainable. We have vast amounts of QE, and people are stuck at home with money they can't spend. And I think a lot of it is going into the stock market.
Yeah.
And, I think one of the reasons that share price is doing so well is that it's just sheer volume of money from actually private investors. So in the near term, I expect these trends to continue, but I think you have to get out at some stage. And going back to the gold miners, one thing I would say is that I completely agree with you about gold and its long-term attractiveness. And one of the things I like about the gold miners is historically they have not been profitable. And now they're massively profitable, but their multiples, their PE multiples, remain very depressed because they're associated with being high-risk stocks which have kind of oscillated between losses and profits, and now they're solidly profitable. And I would expect them to re-rate.
So I think, is it Newmont Mining is on something like a price earnings multiple of 10, but also dividend yields of 2.5%.
Right.
For example. And I made a note here of these are a few quotes about gold. So this is Jeffrey Gundlach in October, this year just gone, 2020. The fiscal explosion sparked by the coronavirus will ultimately lead to a much weaker dollar and much higher gold price.
Yeah.
Ray Dalio, June. It's wise to hold some of what central banks can't create more of and are purchasing aggressively. Paul Tudor Jones in July. Gold is our preferred investment for the next 24 months. And a chap called Kirill Sokolov, who was ranked by the FT as the world's greatest market economist in October 2020, all roads lead to gold.
I agree with that, and I think that all investors should have some. However, there is a question of how much you should have. And the other thing I would say, Richard, is that in March, for example, you'll see that when the market fell, gold fell as well. And that's because it is a safe haven. And when your rest of your portfolio is falling and you've got a margin call and you need to raise some cash, you sell some gold. And so when there's a market sell-off, gold also tends to fall. And if you look back at the financial crisis of 2008, you saw that gold actually fell by 30%, and then recovered very strongly. So when people are forced sellers, gold suffers as well. So it is a safe haven, but
portfolio sizing is important.
So I also had a good year, although not quite in the same league as Richard, but still extremely good.
So talk us through your how you started the year, Keith, and how it developed.
Right. Well, I was less concentrated than you were, Richard, and I made a total of 35%, 34.6% over the course of the year, which I was extremely happy with, frankly. Compared, the FTE All Share recorded minus 13.5% over the year. Now, I was also extremely lucky, but I started the year in late 2019. I became very concerned about valuations. And so I sold all my equities and moved into a mixture of gold, cash, and bonds. I'm just going to bring up my portfolio. Richard, can you see that?
I can, yes.
There we go. So you see that at the start of the year, as the market sold off, my portfolio went up. Now, that was mainly because I had very few equities. I was only about 10% in equities. The majority of it was in government bonds. So I had about 50% in UK bonds, a global government bonds ETF, and also various durations of US T-bills. And I was particularly keen on having American government bonds because I was bearish on sterling. Basically, I thought Brexit would be disruptive and with potentially negative outcomes for sterling. Then as the equity market sold off, as you can see from the performance of the all share, I at some stage made the decision to switch out of my bonds into equities. And you can see from this chart, I didn't get the timing quite right. And if you look at, there's a sharp downturn mid-March, and that is me essentially buying highly cyclical stocks, which I expected to benefit from a turnaround in the stock market slightly too soon. Then as equity market and frankly all markets recovered, I did very well in the period to June, and essentially over that period I did very little trading, holding on to my gold positions. Obviously gold peaked in around June.
Did you have very much in gold miners at that point, Keith?
I had a decent, I had about 10% more portfolio, which I upped to about 20% over the course of the year. And I didn't really sell much gold. Actually, if we move on to my asset allocation. So I do my performance every week. And so I have statistics on what my positions were, what the value of the portfolio was of every Monday, apart from when I'm on holiday. So there were a few gaps during the year. So here you can see the switches I made. So you see at the start of the year, I have about 50% of the portfolio in bonds and about 30% in gold. Now, as gold rises in value, its proportion of the portfolio also rises. Equities are relatively small proportion, and frankly, quite a lot of those are defensive stocks. So utilities or tobacco, which weren't doing very well, and I actually sold out of during the year. Right. And then you see there's a big switch. There's a big switch, and I completely sell out of my bonds, and I switch into equities. Now, I was very lucky at the start of the year to have so much of the portfolio in bonds, basically because I thought that equities were overvalued and we were due for a cyclical turn. And then the COVID comes, and that is a completely unexpected exogenous shock. But I see that actually it plays into my portfolio. And so it's then a question of holding on and waiting for the crash to come. And also, I did something else. So this chart shows the sub-allocations within my bond portfolio. And what you'll notice is that as I realized that the COVID was going to cause much more disruption to the world economy than I thought markets were expecting, and I anticipated there'd be a recession. I didn't, frankly, expect the UK to go into such a hard lockdown for such a long period, but I expected there to be a lot of economic disruption. So I then switched out of short-term bonds into long-term bonds, which are much more sensitive to interest rates. So if you expect the US Federal Reserve to cut interest rates hard to stimulate the economy, then 20-year bonds react much more strongly. Their price will go up much more than will short-term bonds. And so you see me switching out of short-term bonds and into long-term bonds, which was a trade that paid off very well until the completely unexpected happened in March. And what happened was the US Treasury market, which is the market for US government debt, which is the most liquid market in the world, essentially stopped functioning. And so little old me, with his few £100,000 worth of US long-term government bonds, I couldn't actually sell out of the whole position. I'd already sold some, but to sell the remainder, and bear in mind the price had actually gone right up. So, but then it doesn't matter what the price is theoretically if you can't actually sell it.
Yeah.
And I just couldn't get out. There were no bids. And that's, you know, trying to sell a very small amount. And I think when we look back at the reasons for that dysfunction, they're quite interesting. So we're going to talk about, in our review of the year, some of the reasons for the strong market sell-off. And the reasons for the treasury market dysfunction are related. So what happens was that there are a lot of hedge funds which are very heavily geared. And what they do is they trade between the future and the cash in the US Treasury market. Now, and you're trying to arbitrage very, very small differences between the price in the futures market and the price of the bond. We're talking of fractions of cents on the dollar. So in order to make this remotely profitable, you have to use enormous amounts of gearing. And then when volatility picks up in the treasury market, they lose money, and because they're geared, they lose vast amounts of money. And that makes them more risk averse. So they then just try and get out. And so liquidity in the market dries up. The banks have very strong regulatory, a very strong regulatory regime these days. And so they're not willing to risk their balance sheet to step in and provide liquidity. So there's fundamentally a lot less liquidity in, I think, all markets than there was before the financial crisis. And I think that is one of the reasons we saw such a big sell-off in equities. So, and everyone uses these VAR models, which means that the risk of the portfolio is a function of the volatility of the market. So as volatility spikes up, everyone tries to sell to reduce the size of their positions. And so as a result, what you see is that in the largest, most liquid market in the world, there were no bids for 20-year plus treasuries. And it was absolutely extraordinary. I was trying to get rid of, you know, frankly, tiny positions. And my stockbroker would simply not accept the trade.
Extraordinary. That's really, so of course, that persisted until the Fed stepped in with vast quantities of liquidity.
Precisely. And this is the big theme of the year to me. Essentially, governments they have no tolerance for market dysfunction, and they will throw money at the problem. So what you've seen is massive liquidity injections and swap lines with international banks to provide them with dollars, which has flooded the world system with dollars.
Yeah. And which is thought probably to be one of the reasons why the stock market is on a apparently never-ending upward move. And
yes, I think one of the things about the stock market and the the way the Fed and central banks view the stock market is that they now seem to have a high stock market as a policy objective.
Yes.
And one of the reasons they do that, they think in that way, is because they are targeting a wealth effect. So in the last 10 years, the global economy has not been doing terribly well. Demand has not been very strong. In part, that is because of inequality. So rich people who have all the money tend to spend less than poor people who have who have less and would like to spend. Yeah. So as you have increased wealth inequality, you have a structural problem with demand. And as asset prices go up, it is empirically observed that a £1 increase in the value of people's wealth tends to result in an increase of about 10p in demand. So if you keep asset prices high and rising, you will support demand. And I think now you see central banks explicitly trying to support asset prices, which is good for people with assets. The other thing that I would like to talk about when reviewing my portfolio, let me bring it up again, is later in the year, I made a mistake which I don't regret. So if I share this screen, you'll see that, actually it's not that slide, it's this slide here, which shows my asset allocation. You'll see that I reduced my holding in gold late in the year, and I bought more equities. And then in early December, I reversed course. And what was happening there was that Boris Johnson had announced that he thought a hard Brexit was very, very likely. And I have consistently underestimated populism. So I got Brexit wrong. I got the election of Donald Trump wrong. And I thought, if we do have a hard Brexit, then UK domestically orientated stocks will be toast and sterling will be toast. So in one day, I sold the lot. Now, and clearly that was wrong. Sterling has since rallied. I sold the house builders and they've all rallied extremely strongly after that. And that has undoubtedly cost me money. However, at the same time, I don't really regret it, in that clearly I misread a gambit by Boris Johnson to try and increase his negotiating leverage with the EU. Yeah. But at the same time, I had made very good money out of the house builders. They're up 40%. I probably could have sold them, if I'd held on, sold them higher, having made 50 or 60%. But I still made a very good profit. And also historically, one of the things I have struggled with is actually implementing ideas. So you and I, Richard, will sit and talk about the markets, and often I will see dangers coming on the horizon and I will absolutely fail to do anything about them. We will talk about it, but I will fail to follow through. And in this case, I thought, right, this time, new policy, I'm actually, if I think there's something that needs action, I'm going to do it. And historically, when I look back at my portfolio, the things I regret are when I failed to take action, not when I took action prematurely. So in this case, I made a decent profit. I could have made more. I switched all the money into gold, and of course sterling then rallied, but gold is rallying, and in the short term my ability to predict what's going to happen to the gold price is zero. Yeah. But in the medium term, I know that central banks of the world are going to be printing money like mad. And
it's very important, I think, that you manage your portfolio in a way which you feel comfortable with. And if you're feeling very anxious about it, you will probably start doing the wrong things, because you'll think about things from the point of view of anxiety as opposed to as a more logical approach. So I think, at any point, if you feel that you need to get out of something, then you're not doing the wrong thing, and you can always get back into it.
precisely.
But if you don't get out of it and something nasty befalls it, then that money is lost and you can't get it back. So you don't want to get whipsawed, but neither do you want to stick to your guns come what may and go down with the ship to sort of mix reports. So I thought you did the right thing.
Well, the other thing is, would I buy, that UK house builders, would I buy them at these levels?
Yeah.
And actually, the honest answer is no. But I was holding them in quite large size on the portfolio at these levels.
Yeah.
And so, I don't regret getting out of them. We can talk about the outlook for, the UK market later on when we do the predictions for 2021. But I think that the market is discounting a lot of future economic growth, and the extent to which all the good news is in the price is debatable. So I thought we'd each discuss a trade which taught us something or was of interest during the year. Now, I know Richard is going to talk about Bitcoin, so take it away.
Thank you, Keith. So Bitcoin. So I've picked Bitcoin. I know that the Bitcoin is it's a bit like Marmite, isn't it? People love it or people hate it. And as I said earlier, I view it slightly differently. I don't see it as a store of value so much as I see it as a facilitator of a new type of technology, i.e. blockchain mediated disintermediation technology. And I view Ethereum in the same way. So I may be wrong, I may be proven to be wrong, and time will tell. And I have come to understand this, in inverted commas, I've come to understand this over the last year or so. So I actually originally had some Bitcoin sort of somewhere around here, probably more like here actually. And then I didn't sell it when I didn't have very much at all. I didn't sell it when it got here. I held it, and I held it all the way through here. I held it all the way through here. Oh. And at this point, I started to think, I wonder if it's going to start going back up. And the reason I wondered that is because there's this thing called the halving, or the halvening, which is basically where the Bitcoin miners are the people who process the transactions. The amount of Bitcoin that they're awarded for each transaction processing is halved. And there have been several halvenings previously, and each time there's been one of those, there has been this exponential increase. The last halvening was sort of here off the graph, very roughly. So we have this happen. It actually happened in June. And if you look at the logarithmic graph, you can see the previous halvening happened here, somewhere around here. And the one that I'm referring to happened here. Now, what this graph doesn't take into consideration is it doesn't take into consideration the last few increase that we've recently had in the price of Bitcoin. But you get this, and this is obviously a logarithmic graph, which is following a straight line, which means that in general the price is following an exponential trend. But it has been following a logarithmic trend with admittedly very, very wide spacing. Mm. And so extreme volatility. It's been following it for the last 6 years. A steady with a constant exponent, if you like, if you do the trend. Whereas here, clearly, it was a different exponent. So if you look at this, then your projection for the price of Bitcoin would be somewhere around about, I don't know what's that, 170 or something like that, $1,000. I'm not saying it's going to get there, but this is where it is. So my point is that if you're right, you don't need a very big investment to get an absolutely enormous return. And if you're wrong, you will lose a relatively small amount of money. So it is a very asymmetric trade. And sorry, I've just let me stop the share now. So for me, it's a little bit like, well, I think this is going to happen. I think that there will be disintermediation of all sorts of current activities, and also new things that blockchain can do that won't disintermediate, but there'll be new things, or won't necessarily specifically disintermediate. And so it's a little bit like, well, why not? And as I say, I'm not hung up on the store of value issue. I'm not looking at all these other token issuers, which may or may not be successful. I'm saying that I suspect that blockchain and Ethereum will form part of the fundamental architecture of blockchain technology over the next fairly long period of time. My bet is relatively small, but the potential for gain is enormous.
Thank you, Richard. That's very interesting. But can you actually tell us how you physically have done this? Okay, and
I bought them and they just sit on there.
I talk in jest, but we both know somebody, a friend of ours, who has actually been buying on the dark web with Bitcoin. So clearly, you can actually, in order for that trade to, the seller to be successful, he has to be able to convert his Bitcoin back into sterling or US dollars, whatever, without alerting the authorities to what he's doing.
So one of the things that's happening now is institutional investors are starting to buy Bitcoin, and they're not starting to buy it because they wish to buy large quantities of marijuana, as far as I'm aware. But I think they're starting to buy it because they perceive that this is potentially the gateway to the world of disintermediation, so whilst yes, there is this minor use, I would say relatively minor use for some nefarious activities and so forth. My view is it's not the main use. My view is that it will in some way get regulated out of the system to an extent, and that the use, the concept that it's used by money launderers and criminals it may have been true in the past, but I think it's becoming less so now.
Right. Well, I'm going to push back on Bitcoin. So I think that blockchain technology may be useful in a few very specific circumstances, but that is quite different from Bitcoin. And I think Bitcoin, as one of the first of these cryptocurrencies, has some quite serious problems. In particular, it's an ecological disaster. So, it uses up the electricity supply of a small nation, literally.
So I agree. I mean, it does. It's very energy intensive. The processing of the transactions is very energy intensive. What I would say is there's an awful lot of software development going on around the periphery, which actually some of which is aiming to reduce the energy intensity of it by, and I'm not technical here, so I'm now out of my depth, but by accumulating transactions and then processing them as a block. Other pieces of software that sit on the side and so on. So I think what we can say is, yes, it is, and yes, it has defects, but a lot of very, very bright people are working on removing these defects and making it more efficient. And in a sense, it's a bet on whether they can achieve it or not. If they can, it pays off. If they can't, it doesn't.
Well, on the price of Bitcoin, Richard, you clearly have been right. Okay, so the price is the ultimate arbiter, and right now you're doing very well. However, as a speculative asset, and I think it's fine, and it's clearly doing well as a speculative asset. However, when you look at the graph you brought up and you say, well, this halvening leads to rapid increases in the Bitcoin price, which is empirically correct. I mean, what I would say is that, okay, let's not do a halvening next time. Let's do a tenthening. Does that mean the price is going to go up to infinity? You know, clearly there's a stock flow problem here. So that as long as you have more people coming in who want to buy Bitcoin than there are coins being sold either by existing participants or created, the price is going to go up. My concern would be the moment it flips, it could flip very quickly. And actually the clearing price, when everyone holding a speculative asset wants to get out, that clearing price can be really, really low. And if you look at the great like speculative bubbles in history, like Dutch tulip bulbs, you know, once the speed with which it crashes is really extraordinary, and you have to be very fast on your feet.
So I would say, Keith, you may be right. In a sense, it's a sort of so it's very difficult to invest in blockchain technology at the moment because there are very few listed companies that do it, and a lot of investment is via venture capital and so forth. And if you want to invest in a disintermediation, it's difficult to do it on the public markets. What I would say is that it's actually the disintermediation, which is going to be, what's going to be the next Facebook or Google or whatever it is that arrives out of disintermediation. There will be something, I'm sure, but we don't know what it is. So I think the concept, for me, the concept is at some point these tokens will be fully valued, whatever fully valued is, and the future value will be investing in software, which is very difficult to do at the moment.
Okay, let me push back on that, because the thing is, so there are two aspects of Bitcoin. There's the transactional aspect, you know, buying your marijuana on the dark web, and then there's the value aspect. And you clearly, you know, are in it for the speculation. But the two, if it are actually have an oppositional relationship, because if you want to buy, you know, your coffee from Starbucks, or you want to buy something from Amazon, and the value of Bitcoin is oscillating by 20% every day, it is a really very poor transactional medium. The other thing is that I read a book last year about the founder of the Silk Road website on the dark web, which was basically an Amazon marketplace for drugs. This is about, I think, years ago now, 2013. And that was very interesting that he was being paid in Bitcoin. He was regularly having his coins stolen. This was a huge cost to him. And also, I mean, A, you got tracked down, but B, you know, one of the prime uses of Bitcoin is that it can't be tracked by the government, and it does facilitate these let's call them alternative markets. But if those were ever to get too big, the governments of the world could close Bitcoin down in a matter of days. It would just stop people being allowed to transform Bitcoin into US dollars. You say, right, next month you can't do this. There's a sudden stampede out, and the value of Bitcoin just disappears. So,
I mean, you're right, but I think you're coming at it from the wrong point of view. I think the point of view is that we're looking at a structural shift in the way. My point of view is that we're looking at a structural shift in the way transactions are undertaken in the world economy.
Okay, let me actually, Rich, let me just push back on that, because the other thing I learned from the book, whose name currently escapes me, is that the problem with the ledger system is that it's essentially only one way. You can never go back and correct it because it only moves forward. So when Ross Ulbricht, the proprietor of the Silk Road website, was having all these Bitcoins stolen, he could never get them back, because the moment they were sold, they were written into the ledger as the ownership having been transferred, and you could not undo those transactions. Now, if you think about the...
I'm going to draw an analogy, Keith, here.
What?
I'm going to draw the analogy with the steam-driven automobile, which didn't have acceleration, was useless, needed to be fired up with coal, didn't have brakes worth talking of, had to have a man walking in front of it with a red flag, and fundamentally was a completely pointless piece of equipment that was going nowhere. So everything you say about it is true, but not necessarily true going into the future. And that's where I don't disagree with anything you say, but I'm looking at it from a different angle.
Okay.
So I think we have to agree to differ on this one, probably.
But I think we're going to bicker continually every week in a way that hopefully the listeners
and possibly will be
entertaining.
Depending on what happens. Yes. So anyway, let's move on now, Keith. We've done this one to death. Let's move on to what the security that you wanted to talk about.
Right. Okay. Well, I want to talk about, although I had a good year, my main trade actually was not a success. And I wanted to talk about my trades in BP, he says, switching on the wrong one. So, as we discussed in the opening episode of Portfolio Matters, one of the big cycles I trade is the energy cycle. And so just to reiterate, essentially, when the oil price collapses, everyone stops investing in new oil wells, and existing oil wells, as oil gets pumped out and used, means that the supply of oil will decline, and because nobody's investing in new wells, there will be a supply gap. There won't be enough new oil coming online, and so the cure for low oil prices is low oil prices. Lack of investment now means in the future the oil price must rise. So when the oil price collapsed, and you may remember it collapsed to minus $40 WTI in March, I held on, and you see that as the BP share price came off, I bought in March at £3.15, and then it continued to come off, and frankly I expected not to get the bottom, because you never get the bottom. And so when share price went down to £2.99, I bought a lot more, and throughout the summer I looked okay but not great. So frankly, currently the oil market is a very artificial market, in that OPEC have taken 7.7 million barrels per day out of the market to support prices. So it's not a real market. It's OPEC actually have control of the market. But then late in the year, as COVID dragged on, the BP share price fell further, and it fell to substantially below the price at which I'd got in. Now, I seriously think that part of the reason for the weakness in BP is this ESG investing, and we see the flip side of this in the extraordinary performance of clean energy companies. Now, this isn't the place to have a prolonged debate about the relative balance in the oil market and whether I'm right or wrong. But what I want to say is that what I got wrong, I don't regret this trade at all. And I have now a substantial position in BP, which yields they're 4.5% in an environment where interest rates are zero and where I think the oil price will rise over the next few years. What I do regret is I got the sizing all wrong. And this is the reason I want to talk about this trade. So I held on until I thought the BP share price was bottoming. And then I bought it at £3.15. And I bought more at £2.99. Now, the truth is, of my total position, I probably put about 40% on in that first trade on the 9th of March. And I just put far too much on. What I should have done is actually done a much smaller trade to see what would happen and then waited until actually the share price turned up a bit and then put a much larger trade on. And if I'd done that, I would have got a much better starting point. As it is, at the end of the year, the BP share price is £2.54, and I'm actually lost money on this trade, which is in terms of my equities, it's my second largest position. My largest position is Shell, and I'm only up 10% on that. And the reason I did exactly the same with Shell, the difference is in November, I bought a lot more Shell in a way that I didn't buy a lot more BP. So although I did 4 trades in BP in November, they were actually relatively small. All 4 of them do not add up to my trades on the 9th of March. So the lesson I want to take away from this, and it's a lesson I have tried to learn on several occasions, and this year demonstrated that I have not actually assimilated that lesson, is that I've got to start, no matter how, what my confidence is, I've got to start small and then increase my position. I mean, the fundamental problem was overconfidence.
It was particularly difficult, I think. You were sort of catching a falling knife with your first entry, weren't you?
Yes.
And
I shouldn't have done it in size.
Yes, but of course you never really know whether you've hit the bottom or not until the bottom is in and gone. So, but Keith, why do you want to invest in oil at all, given the current environment?
Well, the thing is, when you look out the door, Richard, how many electric vehicles do you see? The reality is, of only a very small proportion of electric vehicles, of all cars on the road, are electric vehicles. Now, the average life of a vehicle is about 10 years. So right now, I think the share of fully electric vehicles in the UK is something like 5%, is that right?
Mm-hmm. Okay.
And so 95% of cars, 100% of diesel, 100% of ships are all petrol, as are all aircraft. And also, we're talking about in developed markets. In developing markets, 100% of vehicles are all petrol. So in the medium term, yes, there could well be a transition to electric. But I think in order for that transition to occur soon, you have to make some heroic assumptions.
So,
So in that case, I think the traditional oil cycle has at least one more cycle in it.
So you mentioned that OPEC it's an artificial market at the moment. OPEC has withdrawn something like 7 million barrels a day from the market.
Yes.
So, assuming we get back to some sense of normality over the next 9 months, let's say, with regard to COVID, that amount of production will come back onto the market.
Yeah.
We don't really know what's going to happen to demand, I guess, because things are going to come back slightly differently to how they were this time last year. And despite that amount of oil coming back on the market, presumably your assumption is that the price of oil will go up, which will then cause the share price to go up, profitability of these companies to go up.
Precisely. Yeah, That's exactly right.
So is that sort of a hope, or is there more to it than hoping that will happen?
No, it's absolutely a calculation. So this is how I've made a lot of money over previous cycles. Essentially, what's happened to the oil market over the last 10 years has been an enormous supply shock from US shale. So if you look at the balance in the world of supply in oil markets, essentially 100% of the growth in oil supply and more has come from US shale. Now, the thing about US shale is it's never actually earned any money. It's burnt a lot of investor money over that period, and it's only had, I think, 1 quarter in which it was cash flow positive.
Right.
In addition, they have drilled out a lot of the best areas. So there's questionable how much growth there is left in that business, and certainly how much growth there is at reasonable oil prices, because no matter what they say, the reality is when the oil prices are $65, the shale patch was still cash flow negative. Now, it wouldn't be now because they're more efficient. But what that means is when the world goes back to normal and everyone, as a result of government stimulus, has money in their pockets and a burning desire to escape their homes and go on holiday, I think that international air travel will recover remarkably quickly. And actually, if you look at what is depressing oil demand at the moment, you'll see that demand from transportation is running actually only about 20%, 15 or 20% down from where it was last year. It's air travel which is causing the big drop in demand. People can't fly.
So what do you see the price going back up to?
That's a very good question. Actually, Richard, I don't want to speculate too much, just it's going to go up.
Right.
Because actually it all depends on US shale and what happens. And if the oil price hits $65 and US investors think, oh, this time is different, this time I'm going to make a lot of money in US shale, let's give them a load of cash and for them to drill, they will once again probably kill the oil price. If this time they think, no, we've seen this game twice before and lost our shirts, we're going to stay out of it, then the oil price could go very high.
So Keith, what would be your trigger for moving out of these positions?
The oil price hitting my targets, essentially. Because, I mean, that's the thing. So the cure for high oil prices is high oil prices. And when the oil price goes high, suddenly all these oil executives start drilling like mad. And 6 months to a year later, you get some extra supply. And frankly, this is what I think is going to happen to all the commodity stocks, which you or I are currently have large positions. So to digress slightly, one of the positions I hold is in a Ukrainian iron ore miner, and iron ore is at the highest price since the end of the great financial crisis, when it did precisely the same thing. So coming out of the great financial crisis, the price of iron ore skyrocketed on Chinese stimulus. It then essentially slowly subsided for the next 6 years. And I see exactly the same thing happening. Because
so, if you didn't have any holdings in oil at the moment, would you be entering the trade now?
Yes, absolutely. No, I'm adding to the position, frankly. Yes. Now, has the oil price gone too far currently? That it may well have done. And it's an entirely artificial market. If OPEC decides to open all the taps tomorrow, the oil price could go to zero again. So really you're dependent on OPEC holding their discipline, not flooding the market and waiting for the transport to fully come back. But going back to the balance of supply and demand, developing markets, their demand for oil just keeps on rising. And so, the bears for the oil price are saying that developed world demand for oil will collapse. There'll be an offsetting collapse. And in the medium term, that may be true. But in the next 2 years, I just don't see it.
I think it's like you said earlier, isn't it, Keith? It's almost the mirror image of the alternative energy stocks. So everything's been concertinaed in what is probably a very unrealistic time frame for things to change, and people's perceptions. So interested. Is there anything you'd like to add, or have we covered the points you wanted to make on the oil trade?
No, I think I've made all my points. Although, the key lesson I like viewers and also myself to take away from this is that to size into a position gradually rather than just going bang, which I keep on saying I'm not going to do this again, and then when I feel really confident about a position, I do it. And of course, I know my timing is not great, but I think, oh well, you've got to pull the trigger at some stage, which I completely agree. You do have to trade at some point, but I think the point is when it's a falling knife, you have to start with a small position, see how it goes, and then increase.
Quite well made, Keith. Thank you very much.
Thank you, Richard. Right, and I think that is going to conclude our review of 2020, and we are going to do a separate video on our forecasts for the year. And
include oil and Bitcoin, presumably.
Presumably, but I think we'll have a lot of other things to discuss, Richard. And I fully expect the coming year to be extremely volatile. So I hope you will join us for that video. And if you've enjoyed this, please can you press like and subscribe to our channel so that we can try and attract some more viewers.
Thank you very much for watching.
Thank you all for watching. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.